Good evening and welcome to today's market wrap. Let's dive straight into the numbers. The Nasdaq closed at 24,438.50, down 0.89%. The S&P 500 ended at 7,108.40, a loss of 0.41%. The Dow Jones Industrial Average finished at 49,310.32, down 0.36%. The VIX, our fear gauge, rose 2.06% to 19.31. The 10-year Treasury yield ticked up to 4.32%, and the US dollar index strengthened slightly to 98.80. The offshore Chinese yuan held steady around 6.8363. Bitcoin was trading at $78,235, down a bit. In commodities, WTI crude oil surged over 3%, breaking through $97 a barrel, while spot gold eased back to $4,708 an ounce. So what was the big theme today? In a word, rotation. We saw a massive sell-off in technology growth stocks, particularly the software and SaaS sector. IBM and ServiceNow delivered what can only be described as disastrous earnings, dragging the entire sector down. The money flowed out of those names and into three clear havens: cash, which explains the stronger dollar, inflation hedges, with crude oil spiking, and a very select few hard tech companies with proven earnings visibility. Gold, interestingly, was not the go-to safe haven today, given the strong dollar and rising rates. Let's walk through the global action step by step. The day started in Asia, and the mood was already fragile. Japanese and Korean markets tried to rally early, following the previous day's bounce in the US. But that optimism was quickly shattered by fresh headlines on Middle East tensions. Risk aversion kicked in, and stocks reversed their gains. Chinese mainland markets were also weak and choppy all day, failing to generate any independent momentum. Asia, in our view, was the inflection point where sentiment shifted from cautious optimism to outright. When Europe opened, it couldn't turn the tide. Major indices were mixed, but the overall tone was one of cautious waiting. Europe essentially passed the baton of negativity to the US without adding much fuel. Then came the main event. US markets opened and immediately confirmed the global risk-off mode. All three major indices opened lower and grinded down through the session, with the selling accelerating into the close. The Nasdaq was hit hardest, led by the software sector's collapse. Texas Instruments did report strong numbers, and that helped a handful of semiconductor names, but it was nowhere near enough to offset the systemic selling pressure across tech. Now, let's talk about what the market is telling us. We saw two very important structural signals today, with a high probability of being confirmed. First, we had the dollar, the 10-year yield, and crude oil all moving higher together. This is a textbook stagflation trade, and it is extremely damaging for growth stocks. Second, we saw extreme divergence within the tech sector. Software is crashing, but hardware is showing a split. Capital is clearly moving away from SaaS models that depend on easy macro conditions and towards hard tech companies that have real orders and earnings certainty. What did we get wrong today? After yesterday's close, we predicted the market would enter a range-bound consolidation phase. That was clearly wrong. The market did not consolidate. It broke down decisively, especially in the final hour of trading. Our core mistake was underestimating the weight of geopolitical risk. We did not fully anticipate how quickly tensions in the Middle East would boost oil prices, and how that spike in crude would then feed into higher bond yields and inflation expectations. The market's pricing priority shifted in the last 24 hours from focusing on economic data and earnings to focusing on geopolitical risk and inflation. Our model did not adjust that weight quickly enough. Looking ahead to tomorrow's Asian session, our message is clear and cautious. Do not try to catch a falling knife. Do not try to buy the dip prematurely. We expect Chinese mainland markets, Japan's Nikkei, and Korea's Kospi to all open lower, digesting the weakness from Wall Street. Within China, AI computing and other policy-driven sectors might show some relative strength, but they will struggle to offset the overall negative external sentiment. There is one potential high-risk, high-reward trade to watch. If a hard tech leader like Nvidia, which has little exposure to the software weakness, gets dragged down by more than 3% purely on panic selling tomorrow, there could be an intraday bounce opportunity. But this is a contrarian bet with a low probability of success. We also need to watch tomorrow's U.S. jobless claims data. Any sign that the labor market remains too hot will put further upward pressure on bond yields. And any headline from the Strait of Hormuz will directly move oil prices and risk appetite. Let's wrap up with our directional conclusion. The market is in a clear risk-off mode. Stay defensive. Wait for the dust to settle. We will not consider adding any new long positions until the VIX drops back below 17 and the 10-year yield clearly breaks below 4.25%. That is our line in the sand. The only thing that would invalidate this bearish view is if the S&P 500 manages to forcefully reclaim the 7,150 level in the next 24 hours, or if crude oil suddenly crashes by more than 5%. Until then, caution is the name of the game.